You've had a good week, maybe two. The trades are working, the setups are hitting, and somewhere along the way, something quietly shifts in how you're approaching the market. You may not even realize it. You're not just trusting your strategy anymore, you're certain of it. The next setup doesn't feel like a probability, it feels like an obvious winner. The analysis that used to take 10 minutes starts taking 3 because the conclusion feels obvious before you've even finished the chart. You start entering trades and expecting it to be a winner. You're getting used to that feeling of only making money and not losing it. You've stopped thinking in probabilities. You've started thinking in guarantees. And then one trade goes wrong. And instead of accepting it the way your process says to, log it, move on, wait for the next setup, something different happens. You can't accept it. Not because the loss is large, but because the guarantee just broke. The streak said the next trade was a winner. The market disagreed. And that gap between what you were certain would happen and what actually happened creates a pressure that almost always leads to the same response. One more trade to prove the certainty was right. This is overconfidence. Not the arrogant kind that looks obvious from the outside. The quiet kind that builds inside a winning streak and feels exactly like skill until the moment it starts costing you everything you built. Today, we're going into why winning streaks breed this specific kind of certainty, what it does to your brain and your decision-making, and the part most people miss. How to stay in full control of your trading, right at the moment when overconfidence is most likely to take it from you. Let's start by defining overconfidence precisely. Overconfidence isn't the belief that you're better than other traders or believing their strategy will win 100% of the time. Most traders who suffer from it aren't walking around thinking they're exceptional. They're just feeling good. The trades are working. The account is growing. And gradually, almost imperceptibly, the standards that govern their decisions start to loosen. The checklist that used to require 5 conditions now gets triggered by 3. The position sizes that were carefully calculated start creeping up because the account can handle it. The setups that would have been passed on 2 weeks ago get taken because the recent track record makes them feel safer than they are. None of these feel like lapses in discipline. They feel like earned confidence, like the natural evolution of a trader who's been doing things right. That's the disguise. Overconfidence presents as competence. And because the recent results support the feeling, the wins are real, the streak is real. There's nothing obvious to tell you that the standards are slipping until the loss arrives that exposes them. And here's the part that makes it particularly dangerous. The loss doesn't just hurt financially. After a winning streak, a loss feels disproportionately wrong. Not because of the dollar amount, but because of what it threatens. The streak, the identity, the story you'd quietly started telling yourself about who you are as a trader. That emotional weight is what turns a normal stop-out into the beginning of something far more expensive. Okay, to understand why winning streaks are psychologically dangerous, you need to understand what they do to the brain. Because the neurological response to consecutive wins is more powerful and more distorting than most traders realize. Each winning trade produces a dopamine release. We've covered dopamine in the previous videos. It's the brain's anticipation and reward chemical. Under normal trading conditions, wins and losses balance each other out, and the dopamine system stays relatively calibrated. But during a winning streak, something different happens. Each consecutive win produces a dopamine spike, and those spikes compound. The brain begins to associate the act of trading with reward more strongly with each additional win. At the same time, the brain starts to update its risk model. This is a process called outcome bias, where recent results disproportionately influence future probability assessments. After 5 winning trades, your brain doesn't calculate the probability of the next trade based on your strategy's historical win rate. It calculates it based on the recent run. 5 wins feels like evidence of elevated skill, elevated edge, elevated certainty. The brain treats the streak as data and uses it to justify taking more risk. There's also a well-documented psychological phenomenon called the hot hand fallacy, the belief that a person who has experienced success has a higher probability of continued success. Originally studied in basketball, where players and fans consistently believed that a player on a hot shooting streak was more likely to make the next shot, even though the statistical analysis showed no such correlation. The same fallacy runs in trading. A winning streak does not change the underlying probability of your next trade. Your edge is what it is. The streak is variance, positive variance, but variance nonetheless. And here's where it gets costly. The dopamine-fueled confidence combined with outcome bias and the hot hand fallacy creates a neurological environment where the brain is systematically underestimating risk and overestimating certainty. You feel sharper than you are. You feel more in control than you are. And you feel that a loss, when it comes, is more unacceptable than it was before the streak began. Because the streak has quietly raised your psychological baseline for what normal looks like. Now, there's a specific pattern that emerges from overconfidence, and it does the most damage in the shortest amount of time. It's the emotional attachment to the streak itself. This goes beyond the normal experience of a winning run. It's the point where the streak stops being a byproduct of good trading and becomes something a trader is actively trying to protect and extend. The wins are no longer just results, they're an identity. And when that identity gets threatened by a loss, the response isn't to log it and move on. The response is to do whatever it takes to get back to the version of yourself that was winning. This is where overconfidence and revenge trading overlap. The trader who takes an unnecessary trade after a loss during a winning streak isn't primarily responding to the dollar loss. They're responding to the identity loss. The streak meant something. It was proof that they had arrived, that the work had paid off, that this time was different. A single loss threatens all of that. And the brain, experiencing that threat, pushes hard toward the one action that could restore it, another win. The problem is the same one we've seen in every other emotional trading pattern. The trades taken in pursuit of restoring a streak are not based on analysis. They're based on need. And trades based on need have a worse average outcome than trades based on edge. Consistently, measurably, across every account and every experience level. What makes the win streak scenario uniquely dangerous is the scale of what's at risk. A trader who has been building for weeks or months, who has accumulated real gains, real proof of concept, real momentum, can give most of it back in a single session of streak chasing. Not because they're undisciplined in general, because the emotional investment in the streak was so high that a single loss triggered a response disproportionate to its actual size. The gains that took weeks to build, gone in a Tuesday morning session. That's not hyperbole. It's a pattern that plays out across trading accounts at every level, in every market, with every experience level. The streak makes the fall longer because it raised how far there was to fall. But here's the single most important thing to understand about winning streaks. And it's something that the feeling of a streak makes it very difficult to hold on to in the moment. Every trade you take is completely independent of the one before it. The market has no memory of your last trade. It doesn't know you're on a 6-trade winning streak. It doesn't know you've had 3 green weeks in a row. It has no record of your performance and no obligation to continue it. Each trade begins with the same probability profile your strategy has always had. Not elevated because you've been winning, not deflated because you've been losing. Exactly the same. A winning streak does not change your edge. It does not compress the probability of the next losing trade. If your strategy wins 55% of the time, it wins 55% of the time, whether you're coming off a 10-trade winning streak or a 10-trade losing streak. The streak is your experience of variance. The probability is the underlying reality. Those are two different things, and confusing them is one of the most expensive cognitive errors a trader can make. This matters especially during periods of elevated volatility, significant news events, earnings seasons, geopolitical developments, where conditions can shift in ways that affect how strategies perform. A trader on a winning streak in a low volatility environment may find that the same setups behave differently when volatility spikes. The streak was real, but the conditions that produced it have changed. This is the time to examine your thinking most carefully, not to trade with more conviction, but with more caution. The discipline required here is not to stop feeling confident. Confidence earned through real results is legitimate and valuable. It supports execution and reduces hesitation on valid setups. The discipline is to hold the distinction between confidence in your process and certainty about the next outcome. You can feel good about your trading without believing you've become immune to losing. Those are not the same thing. And the moment they collapse into each other is the moment the streak starts costing you money. The goal isn't to dampen a winning streak. It's to stay in control during one. And that requires a specific set of behaviors built before the streak arrives, not improvised inside it. The first criteria is maintaining your discipline during winning runs. When the account is growing and confidence is high, this is the exact moment to hold your entry criteria to their highest standard, not relax them. The feeling that things are going well is precisely when the loosening of standards is hardest to notice and most dangerous to allow. A practical way to enforce this is a written pre-trade checklist that doesn't change with your P&L. 5 conditions are required to enter a trade. During a winning streak, all 5 still need to be present. The streak doesn't earn you shortcuts. The second is streak-aware position sizing. Most traders intuitively size up during winning runs, and in some systematic frameworks, there's a case for it. But if you're going to adjust size during a streak, it needs to be rule-based, not feeling-based. A specific percentage increase triggered by a specific milestone with a specific ceiling. Not, I'm feeling good so I'll go bigger. That's the streak making the decision, not you. The third and most important is accepting the loss that will end the streak before it arrives. This is the mental work. Not hoping the streak continues indefinitely, not assuming the next trade will extend it. Knowing, not just intellectually acknowledging, that the streak will come to an end. That one of these trades will be a loss. The loss finally ended the streak. But it doesn't invalidate the work, and doesn't require a response beyond logging it and moving on. When the loss that ends the streak comes, especially when you least expect it, your response to it is the test. Not whether you had the streak, whether you could take the loss at the end of it with the same discipline you brought to the first trade of the run. A trader who can do that is genuinely dangerous in the markets. Not because they win more, but because they never let winning cost them as much as losing does. People talk about discipline like it's something you need when things are hard. When the account is flat, when the setups aren't working, when the market is giving you nothing, session after session. And yes, that kind of discipline matters. Sitting on your hands when there's nothing to trade is genuinely difficult. But that's only 1/3 of the test. The real measure of a trader's discipline isn't how they behave when things are going badly or when things are flat. It's whether the standard holds across all 3 states, the losing periods, the quiet periods, and the winning periods. Because each one attacks discipline from a different angle. A losing streak attacks it through frustration and the urge to recover. A flat market attacks it through boredom and the urge to manufacture opportunity. And a winning streak, the one that feels the least dangerous, attacks it through certainty. Through the quiet conviction that the rules that got you here don't need to be held as tightly now that you've proven they work. That last one could be the most expensive attack of the 3, because it doesn't feel like a threat. It feels like a reward. And by the time it's clear that the standard slipped, the streak has already started giving itself back, faster than it was built, and in ways that are much harder to watch. The streak will end. It always does. The question is whether you end it with discipline, with a small accepted loss, on your terms, or whether it ends you, somewhere in the middle of a session you can't stop, chasing a win you no longer have any real basis to expect. Control the streak. Don't let it control you.